Good evening. Good evening, everyone. My name is Faith Edgar. I am one of the co chairs of the May Week Committee of Delta Sigma Theta Sorority, North Jersey Alumni Chapter. Delta Sigma Theta Sorority, Inc. was incorporated on founded on January 13th, 1913, by 22 collegiate women at Howard University to promote academic excellence and provide assistance to those in need. Since its founding, Delta Sigma Theta has become one of the preeminent service based sororities, with more than 300,000 initiated members and over 1,000 chartered chapters worldwide. North Jersey alumni's commitment to sisterhood, scholarship, and service dates back to June 11th, 1939, when 14 women established the Kappa Sigma chapter, now NJAC, the first chapter of Delta Sigma Theta sorority incorporated in the state of New Jersey. The major programs of the sorority are based upon the 5-point programmatic thrust: economic development, educational development, international awareness and involvement, physical and mental health, and political awareness and involvement. On behalf of our president, Sharon Hardesty, the May Week Committee, and all members of NJAC, I welcome you to this evening's virtual panel discussion on excelling your financial situation with the Moneynista so that you can learn how to maximize your wealth by leveraging tax code strategies. Without further ado, I introduce to you Dr. Avanya Richardson Miller, May Week co-chair, and the moderator for this evening's discussion.
Thank you, Sora Faith, and good evening, everyone. First, let me just take care of a couple of housekeeping things. We are coming to you live this evening through StreamYard, and I just wanted to set the expectations for the evening. The video will be limited to our guest speaker and the moderator. So as our guest participants, you will not be on a video for this evening, and also want to invite you to use the comment section for any Q&A that you may have or any comments that you may want to post throughout tonight's event. So as my co-chair said, I'm Dr. Avanya Richardson Miller, the co-chair of NJAC's 2023 May Week program. And we are excited to bring this very informative and valuable information to you tonight. And as she mentioned, this year's May Week theme is Be the Force Multiplier. You may be wondering, what is a force multiplier? Simply put, it is a tool or resource that is used to multiply the effects of your actions and the resulting outcomes. Tonight's presentation focuses on how to excel your financial situation with the Moneynista. So you will learn how to build wealth and increase your impact by leveraging tax code strategies. It is my privilege to introduce our guest speaker, Natasha Varela, also known as the Moneynista. So Natasha is a corporate tax strategist, real estate investor, business owner. Her background is 20 years in audit, accounting, and tax, with 13 years experience in Internal Revenue Service, working with large entities and high net worth individuals. As a real estate investor, she has built a portfolio of cash flowing investments that produce not only cash flow, but substantial tax savings with legal tax avoidance strategies. I love that, legal tax avoidance strategies. She holds a BS degree in economics and an MS degree in accounting. Through her educational and formal career training, she has helped her students save over $5 million in taxes through her tax strategies mastermind, which she founded in 2020. She seeks to serve by promoting a path to financial freedom through effective tax planning, using vehicles that shelter tax liability and promote true wealth building. So without further ado, join me in welcoming the Moneynista, our guest speaker for this evening.
Oh, thank you so much. Thank you so much. Welcome, everybody. But first, I want to do a sound check and a screen check. Can you guys hear me? And can you guys see my screen? Please type in the comments, everyone. Good evening, everyone. Good morning, good afternoon, wherever you are.
Mhm.
Okay, just let me know if you can see my screen before I begin and if you can hear me. Just type yes in the chat. All right. I'm getting some yes. I'm getting some yes. All right. All right. Great. Great, great, great. So, without further ado, I'm going to move forward and I'm going to try and answer all your questions and be as thorough as possible. I understand tax can be confusing, but I'm here to make it so simple. I focus specifically on a couple of tax codes because we know taxes are confusing and it's scary to people. But your wealth is, in fact, in a tax code, right? So, what will happen is, as you're building wealth, people will tell you, you should invest in stocks, you should invest in real estate, you should open up a business. And where are all these things coming from? They're coming from the tax code. Okay, the tax code is what's telling you what's favorable as far as income, right? So when people tell you where to invest, whether it's stocks or whether it's real estate or whatever have you, it is coming strictly from the tax code. Okay, and so I'm introducing to you tax code to cash flow. Okay, we have cash flow, which we know what cash flow is, guys, right? Your income minus your expenses, which you have left over. But what's more important is your tax flow. Okay, so I just want to know which one of you guys who I'm talking to, are you a real estate investor? Are you a business owner? Are you both? Or are you an employee? Go ahead and type it in the comments section. Let me know who I am talking to. Let's see, guys. Come on, we need active engagement. So, who am I? I am 100% tax free. I didn't say I don't pay taxes. I said I'm tax free, meaning I don't have a tax liability, right? And not having a tax liability leads to not paying taxes. I don't just not pay taxes, okay? I make sure I move within the tax code. And as I was introduced, I have a BS in economics circa 2002 from State University of New York at Albany. I have an MS in accounting from the College of St. Rose circa 2004. I am a real estate investor, accidental. Okay, accidental real estate investor. I am a tax strategist first and foremost. My 20 years in audit, accounting, and tax. I'm an enrolled agent, and I am the founder of the Money Masters Academy Tax Strategies Mastermind, where I utilize real estate and business ownership. Right, I teach how to build wealth through business ownership and real estate within the tax code because that ultimately is what the tax code favors. Okay, your W-2, not going to work. And so I love to use my own example. This is a real live W-2, my 2020 W-2. Okay, so if you could follow along, I'll try to make this as simple as possible for everybody to understand how important it is to utilize the tax code. Okay, I'm about to wow you guys. So in the upper right-hand corner, you can see I had $19,308 withheld for federal income tax purposes, right? You can see my salary, $109,000. Okay, $19,000 was withheld for federal tax purposes. And then in the lower left-hand corner, so to speak, I had $6,002 withheld for state purposes, right? Welcome to New York. Okay, and so here is my actual tax return for 2020. Can you guys tell me what you see? Tell me what you guys see in the comment section, in the chat. Let's talk about it. What do you guys see? If you see my effective tax rate of 0% and then me receiving all of my money back and then some because we had some COVID credits. Y'all remember COVID, right? We had some COVID credits. I received every last dime back, and I'm going to show you how and why. Okay? This is why they call me the Moneynista. And just because I love receipts, here is my refund from 2020. Don't worry, I'm going to walk you all the way to 2022. So, why taxes? Right now, this information is collected every year and it's posted on the Internal Revenue website. I did not make this up. This is right here in your face. It's not hidden. This is the gross collections by type of tax, fiscal years 2013 to 2022. This was just released. It's usually it's a 10-year or so period, 11-year period. And we can see that the most taxes collected are by what? individual and estate and trust income taxes. The least amount of taxes are collected by whom, guys? I mean, it's right here. It's on. You don't believe me? Go right to the IRS SOI data book, right? Okay, business income taxes. Businesses pay the least amount of taxes. All right. And so if you go to the website, they have it all in an Excel spreadsheet. There's a $15 trillion difference between taxes paid by individuals and taxes paid by businesses. Okay, and that includes real estate as well. Real estate is considered a business, right? So 19 trillion is collected from individuals, right, estates and trusts, and 3 million is collected from businesses. Okay, $15 trillion. There is your wealth. Okay, there is your wealth. So I know you guys know this guy, right? We know him, Grant Cardone. We have to learn to set everybody up, or those who seek to build wealth within the tax code, to set you up as you Inc. because the tax code favors business and business only. Business activities only. So I'm going to give you an example of Grant Cardone. Okay. His accountant calls him because Grant Cardone, people like him have a tax advisor. They don't have just the preparer guys. Okay. He doesn't go to H&R Block. He doesn't go to Liberty Tax. He is a dedicated tax advisor, not just a CPA, a tax advisor. December 10th, 2019, his accountant calls and says, we're going to have a problem. You owe a lot of money in taxes. And because Grant has a lot of money, a lot of resources, a lot of reach, he purchases a $50 million jet Christmas Eve, right? What a good Christmas present. And he flew the plane 2 hours, okay? And that's important because with the IRS, if you purchase an asset, you have to place it in service. That means you have to use it, okay? And because of that, he was able to take 100% of the cost of the jet, right, from his income. So we call it bonus depreciation in tax world. It's a fancy word for expense. Okay, fancy word for expense. He was allowed to take the entire cost of the jet, right, on his taxes and reduce his tax liability by $50 million. So I'm going to show you how we do that in our world. Okay, first of all, we need to understand tax is a back-end transaction. You have to do something on the front end before you get relief. This is where most people go wrong. All right, they get their check. They get they do their budgeting. They only focus on what hits their bank account. They do not focus on what does not hit their bank account. And that's where I'm here so that you guys can start looking at your gross pay and not your net pay. All right. You cannot wait for your W-2 in January and treat it like a holiday. You're never going to get anywhere. Okay. Dependence, marital status, that is not a tax strategy. Okay. Child credits, right? Earned income credit, that is not a tax strategy. Okay. That will get you nowhere. All right. So let's talk about some tax tales versus the tax truth. The first one is tax season is January through April. The truth is tax season is all year long. January through April is only filing season, or what I call reconciling season, right? What you paid throughout the year versus what you owe and maybe are due back. Okay. Tax season, we are in tax season. Tax season is 365 days a year. Every day you earn a dollar, every day you breathe, you are paying taxes. Okay. Tax tale number 2, taxes are too complex to understand and use. You're right. They're very complex. The tax code is lengthy. Okay. It's over 75,000 pages. But the truth is you only need to know a few pieces of the tax code to shelter your income. And I focus on the ones that those of us who are W-2 workers, right? Getting it out the mud, trying to build wealth. I focus on the tax codes that are applicable to us, right? The truth is the average individual, right, or small business only needs to know a handful of the tax code to shelter income. And here it is, you guys. Okay. Section 6001, books and records. Section 469, passive activity losses, which include real estate professional status and bonus depreciation. Okay. And in addition to that, you need to know that the tax loopholes I don't even like to use the word loopholes because it's not a loophole. It's the law, right? Tax loopholes are for the rich. That's a lie, right? Tax code is for everybody. Okay. Everyone. That's me at 4 years old. Okay. I am the child of immigrant parents and wage earning parents. My dad's from Haiti. My mom's born here, roots in Jamaica. It is for everybody. You just have to know how to use it. You have to get into the tax code, okay, and understand it. So how do we use the United States Internal Revenue Code? The first thing you need to know is you have to take your ordinary income, which is your paycheck, and pump that money, or what I call it shifting, into extraordinary income, right, which is real estate and business, right? My business owners, raise your hand. My real estate investors, right? And how do we do that? My favorite, tax avoidance, which is the legal use of tax laws to reduce one's tax burden, right? Tax avoidance is lawful, guys. Then we go down the hierarchy, right? We use tax avoidance first because tax avoidance removes the tax liability in real time, usually permanently. Tax deferral is the next in the hierarchy, right? With things like your retirement, your 401k, right? You don't pay taxes until you receive the money, right? It's tax deferred, right? We remove the tax effect in real time and we push it out into a later date, okay? I always go for tax avoidance first, then tax deferral. So let's get into the nitty gritty, right? Tax code cracker number 1, investment real estate. I do not have a housing cost and I do not have a tax liability. I'll repeat myself. I do not have a housing cost and I do not have a tax liability, all because I operate within the tax code. Okay, so let's get into how. Remember my paycheck I showed you and I got that $19,000 and $6,000 back, all that money, right? If I had no real estate, my refund would have been total of $3,104. Okay, I have an 8x return for operating within the tax code. $3,000 versus $25,000. Who thinks that's a huge difference? Huge difference. It is a very, very big difference. Okay. So let's talk about the 3 different types of property ownership. Okay. So we're going into real estate first and then business ownership. When we go into real estate, particularly in the tax code, we're going into investment properties. Okay. So let's talk about the 3 different types of properties. You have your single family homes, which people use them as their primary residence, right? Not an investment property that you live there, you purchase with the intent and you actually live there. And then you have your owner-occupied investments, which is my multifamily folk, right? Who get FHA loans, they move in one unit and they rent out the other unit or units, right? If it's a triplex or quadplex. And then you have the 100% investment where you do not live. You purchase it with the purpose of renting out every unit in the property or the entire property. Okay, so let's go through single family homes as a primary residence, right? How many of you you have your single family home and you live there, you have no investment property? Go ahead and raise your hands. Raise your hands if you have a single family home and you live in there as your primary residence. I might hurt your feelings a little bit, guys. Okay, so you guys go on what's called an itemized deductions, your Schedule A. You guys know that, right? You deduct your mortgage interest and your property taxes, which are capped at $10,000 as of 2017, right? That good old Tax Cuts and Jobs Act. Okay. And then you have your owner-occupied investments, my FHA people usually, right? You live in one side of the unit and you rent out the other side, or you live in one unit and you rent out the others. And the portion of the mortgage interest and property taxes, right, for the rental units goes on your Schedule E. And the portion that you live in goes on your Schedule A, okay? And with your rental properties, right, the part that you rent out, you get depreciation and any expense related to those units that you rent out that you do not live in. And my favorite is you can offset all income tax, okay? And then there's my 100% investment people, right, like me. I have properties I never lived in, 100% investment. I deduct my mortgage interest, my property taxes, my depreciation, my expenses, and I offset all my income tax liability. So I have cash flow and I have tax flow, right? And no, you do not have to LLC. Okay, I think that's a common misconception. An LLC is a business designation. It is not a tax designation. Okay, it is a business designation. There is no tax effect. Okay, it usually all goes on your Schedule E. Okay, so how many of you have been preparing your return and you're living in your primary residence and you plug in your mortgage interest and your property taxes and the software goes, you're getting the standard deduction, right? Because your itemized deduction, which is your mortgage interest, and your property taxes don't matter because of the Tax Cuts and Jobs Act, right? That's what happens, right? The Tax Cuts and Jobs Act increased your standard deduction, which wipes out your Schedule A, which is your itemized deductions, right? On the left, your Schedule A, right? Most people now, their standard deduction is greater than their mortgage interest and property taxes. So you get no more benefit than a renter. Versus an investment property where you get your mortgage interest, your property taxes capped, right? Any legal fees, repairs and maintenance, unlike your single family residence where you live. My favorite, depreciation, and my ultimate favorite, real estate professional status. And so, like I said, the Tax Cuts and Jobs Act raised your standard deduction, right? So now your Schedule A doesn't matter, right? Your property taxes are capped. Okay, so what did the Tax Cuts and Jobs Act do? It said we don't care about your primary residence anymore. And we're going to show you that by raising the standard deduction and knocking out any benefit you had from owning your property and living in the property. But what we're going to do is we're going to give people who invest in real estate, right, landlords, not only depreciation, but we're going to give them bonus depreciation. Okay, and I highlighted it in green because I'm going to show you the effect bonus depreciation has and why investment property is uber important even before your primary residence. So here goes my primary residence homeowners. I have appreciation and I have equity. You have nothing, guys. Okay, I'm telling you this as someone who sat across from millionaires, billionaires. I've studied their financials and their tax returns. Appreciation is phantom. It is not recognized until realized. That means you have nothing until you sell that property and it is in your hands. Okay, people who are building wealth in the tax code know not to bank on appreciation. Appreciation is just in the air, okay? It means nothing. So I'm going to show you how I realize appreciation in real time with real money, with real estate using depreciation. So this is the core of your real estate code, all right? Internal Revenue Code Section 469. That's your passive activity losses, otherwise known as your real estate, your rental real estate. And how did I get all my money back? These are the 3 items. Real estate professional status via IRS standards, depreciation, bonus depreciation. Again, the Tax Cuts and Jobs Act said, hey, we don't care about your primary residence. We're going to knock out all of that by raising your standard deduction, right? You get no more benefit than a renter, but we're going to give investors bonus depreciation on top of depreciation. I'm going to show you exactly why I keep telling you bonus depreciation is uber important. So let's go ahead and talk about real estate professional status via IRS standards. You do not need a license. The Internal Revenue Code does not say you have to have a real estate license. I know you guys prepared and CPAs say, well, you don't have a license. The license means nothing. Okay? It has nothing to do with real estate professional status. It is your activities, your time, and your documentation. All right? Activities, time, and documentation. I can't stress that enough. So why is real estate professional status so important? What it does is it recategorizes rental activity from passive to active, right? So normally under Section 469, rentals are passive activity. Any losses only offset your rental income and not your W-2 income, not your business income. You can only offset your rental income. What real estate professional status does is say, oh no, now that this is active, we can take those losses and offset all your income, right? My CPA said I have to have a real estate license. That's not what the code says. Okay. The code says you spend more than 750 hours a year actively involved in real estate and have complete records. I'm going to show you how to complete your records. And you spend more than 50% of work-related time involved in real estate. More than. I highlighted more than because a lot of times I will see these IG posts and these memes. Oh, you need 750 hours. No, you need more than 750 hours. And I encourage people to go for 900 hours because if you're ever examined, and I'm always going to speak from an examiner standpoint, they'll take away some hours based upon activities. Okay. Always better to go way above and beyond. Now, I know my W-2 workers, my full-time W-2 workers, the second point, spend more than 50% of your work-related time involved in real estate. This is why your CPA says you need a license, because a full-time licensed real estate professional, right, one licensed by the state, is going to get that pass. Not just the license, but you have to be full-time. A lot of us have a real estate license and we don't work full-time in real estate, right? We still have our regular jobs and we might show properties on the weekends, right? So there's a lot that your CPA, your preparer, isn't telling you, okay? But I'm going to show my W-2 people how to work around this item number 2, right? The second bullet point, more than 50% of your work-related time, because it's difficult when you have a 40-hour work week, right? That's why your CPA doesn't tell you about real estate professional status, because if you're ever examined and they ask you if you work full-time, they will knock out the second bullet point. They will say that by default, most of your time is spent in your regular 9-to-5 job, okay? So let's talk about real estate professional status. There's two parts. There's material participation, and then there's active participation. All right, so what's material participation? You materially participated in the operation of the activity during the year, okay? Right? You participated in the activity for more than 500 hours during the tax year. And by the way, material participation does not only apply to real estate, but it applies to your business too. For those of you who have ever been preparing your return and you have your own business, say you're a sole proprietor and you have your Schedule C, right? It will always ask, did you materially participate, right? That means more than 500 hours, more than 501 plus hours, okay? And I would even say, please go for more than that when it comes to real estate, because this item here, real estate professional status, can knock out all of your income tax liability if you're smart. So that's why I always tell people, go for more than what's stated. Go for way more than what's stated. If you're going for the strategy of material participation, right? Not only go for 500 hours, go for over 750 hours, right? Okay. So I know what you're asking. You just told me go for over 750 hours, right? And then here you're telling me 500 hours. So here is the gotcha. Okay. There's material participation, and then there's this little subcategory called general participation. Okay. I'm going to tell you the difference. Material participation is involved directly in your real estate activities, your rentals. General participation are things like seminars, networking, right? Things like this. Okay. Right. This weekend, right? Wealth building seminars, weekend seminars, conferences. Okay. But you always want to go for more than just general participation. You want to seek out 750 plus hours of material participation. This here is just saying of the 750 plus hours involved, more than 500 of those have to be material. The other 250 plus can be general, but as an examiner, I will always tell you, try to make all 750 plus hours material. And I'll go through exactly what activities are material. Okay. The second part of material participation, you are the only person who substantially participates in the activity, including non-owners. That means your property managers. Okay. So what's material participation? Lawn care, bookkeeping, repairs. You take out your trash, right? Gutter cleaning, snow removal, traveling to your property, supervising renovations, right? How many of you guys do that? Raise your hand. How many of you are engaged in all this stuff? Collecting your rent, paying your mortgage, tenant correspondence, tenant screening, right? Yeah, hiring brokers or interviewing brokers. All of this stuff is material participation. How many of you guys do that? You'd be surprised. You have property out of state, right? You take a flight, that flight time counts, right? All that time counts. Okay. So the second part of real estate professional status is active participation. Okay. You can qualify as an active participant if you can answer yes to both of these statements. I own at least 10% of the property, which is most of us. And I made major management decisions for this property, such as approving tenants and authorizing repairs. How many of you meet active participation guidelines? Raise your hands. Okay. Many of you meet active and material participation guidelines. Okay. You own all of the property. Most of us own all of the property, right? Whether married or single, we own the property. We make the decision as to who will or will not be able to rent, right? We authorize the repairs. We make sure the trash is taken out. Yeah, that's most of us who own property. So let's sum up our real estate professional status, because I like to put it together so that people can see it all in one. You spend more than 750 hours, right, actively involved in real estate. So that's 500 plus hours in material and 250 plus hours in general participation. Now, again, I will say as an examiner, I will always tell people, try to go for the full 750 plus as a material participant, being specifically involved in your rentals. And always try and go for more than 750, like 900. Okay. The second part is more than 50% of your work-related time involved in real estate. Again, my full-time W-2 workers, I'm going to show you how you get around that and how I got around it. Okay. And then active participation. You own at least 10% of the property and you make major management decisions. That's it. Material and active participation. There's your real estate professional status. My CPA said I make too much money. I don't get to offset, all my W-2 income. I make too much. I make over 150. Okay. So here's where a lot of people get confused. Don't worry about all the words on the screen. I just want it up there so that you guys can read it if you choose not to, right? So normally, if you are not a real estate professional, right? My W-2 people, right? Because you can't spend more than 50% of your work-related time in real estate, but you own 10% of the properties and more than 10% of the property, and you take care of everything else. You just can't make those hours. You can offset up to $25,000, right? As long as your adjusted gross income is $100,000 or less, and it starts to phase out after $150,000. This is what your CPA is telling you, and that's for people who only meet active participation. Active, that means you own at least 10% in the rental property, right? Right? That they actively manage and that operates at a loss during the particular tax year. Okay. If you don't meet material participation and you meet only active participation, you can take 20 up to 25,000 off your to offset your income. Okay. And it phases out 150,000. So I tell people this is why your CPA is telling you make too much money, because you only meet active participation. The goal is to meet material and active participation. So let's talk about documentation. Under the tax regulation, section 1.469, and for those of you who don't know, for every tax code, section 469, there's a treasury reg, right? And all it is a 1 in front of it. So for section 469, it's treasury reg 1.469. And all it is a more layman's term, more simple way to explain the tax code. Investors who claim real estate professional status on their tax return must show evidence of the hours spent on each eligible activity and proof of said activity. Right? So you guys can go the old school way of Excel, folders, scanning your stuff in, the hard way. In the Tax Strategies Mastermind, we use Reps Tracker, okay? Real Estate Professional Status Tracker, www.repstracker.com. At the bottom there, you'll see there's a website. You can use promo code Moneynista, and we document our hours here. It is a portal for all your hours. And I'm going to give you a brief representation, okay, on how to use Reps Tracker. So I'm going to play this video for you so you understand how we document any activity that we are engaged in real estate. So just to do a quick demo of Reps Tracker, for those of you who are interested in real estate professional status, whether it's a long-term rental or you want to meet material participation via short-term rentals. So this is the actual dashboard, right? And real quick, I'm going to go over short-term rentals for my full-time W-2 folk, but either way, this is how you will document. To the left, you have all of your options. In the middle, you have your dashboard. Here for 2023, I have 50 hours logged. I don't have to log in more hours because I am a real estate professional via the last couple of years. But you have the hours here, okay? For those of you who want to backlog, God bless you. I don't encourage that. I always encourage moving forward. And you can see you have 2 sets here, material hours and general hours. Okay, general hours are things like networking, courses, those of you who do deal rooms every Sunday, or any sort of networking event or conference or seminar, okay? So you have your year here, and you have your total hours. So the first thing you want to do is you want to go here to My Settings, okay? and you want to see if you engage in short-term real estate investing, right? Okay, and then you'll have a toggle here for short-term and long-term, so that you can track both hours for short-term and long-term. For those of you who are doing short-term and are W-2 and you want to meet the over 500 hours, you would go ahead and toggle to your short-term, okay? So here's our dashboard, here's our hours total, and here's your logs. This is what's going to record as you log activities. The first thing you need to do is add your properties, okay? So you would click on properties, enter a new property, and start plugging in the property address, okay? And it should start to auto-populate, all right? Just putting in any address so you can see, and you would choose whatever best fits, and you would hit save. To add an entry, okay, again, you have to make sure you toggle between short-term or long-term, whatever your property is. You would make sure the date is correct for the dates you spent the activity, the number of hours, perhaps you drove somewhere, you flew somewhere, flying time counts from the moment you leave your house to the airport, whether it's you or your spouse, and I'll show you how to add your spouse, okay? And you choose the activity, right? So for the most part, we always want to go for material participation. And then you choose the appropriate activity. So if you have a property acquisition that was successful, go ahead and click it, okay? And you can choose the appropriate sub-activity, negotiations, property inspections, reviewing sale agreements, and so forth and so on, okay? If you have property management as an activity, go ahead and click on property management and choose the activity subcategory, okay? Travel to property, bookkeeping, collecting rent, dealing with HOAs, leasing activities, all that good stuff. Okay, and you can keep going down the line. Property improvements, okay, performing repairs, third-party contractor, vendor supervision. It's very, very all-encompassing. I love this tool. So you would add the property, right, because you added it here on the left, right, and now it's in your inventory properties. And you would go ahead and describe the activity. And here you see there's a little voice note in case you just want to say it instead of type it. You would just type in whatever activity, travel to property, supervise floor installation, whatever have you, okay? And then you would drop your files here as proof. You always want proof. That could be a deposit slip from your contractor. That could be the plans that your contractor laid out. That could be pictures. That could be your emails between the contractor and yourself, the DocuSign agreement, anything that proves that you were involved in this activity. Make sure you put your hours and your minutes, okay? And then you hit save, okay? So you can also add your spouse. For those of you who are married and one person does not work full-time or doesn't work at all, they can obtain real estate professional status. You can add their hours in as well. And if you file jointly, you can offset all other income, business income, W-2 income, and the like, as long as somebody meets real estate professional status. So you can add your spouse, okay, and add their hours together. All right, so let's get back to the presentation. Okay, so for my W-2 people, I know you're wondering about short-term rentals. We're going to go through that, okay? Let's just address our full-time people, right? Because one of the caveats is that you have to spend over 50% of your time in real estate activities, but you have a full-time job, and that's why your CPA is telling you you're not going to meet the criteria, right? Go get yourself, unless your full-time job is a real estate agent, right? You have a license and you're full-time. Not just have a license, but you're actively full-time, okay? Short-term rentals are the exception. This is your way out, my full-time W-2 people. If you and your spouse doesn't meet, if you're married, real estate professional status, right? Because if your spouse doesn't work and they can meet real estate professional status and you file jointly, they can offset the full-time W-2 income, okay, just so you know. So if you rent a property to customers with an average of 7 days or less, okay, on average, this is a short-term rental. If this is the case, you do not have a rental activity under Section 469, okay? What does that mean? It is not a rental. It is a business now. This means that you don't have to qualify as a real estate professional to recategorize the activity from passive to active, meaning offset all your other income, but you do have to materially participate, okay? So you don't need to spend more than half your total working time in real estate, but you have to materially participate. So what's that magic number for material participation? That's that 500 hours, right? So short-term rentals. To materially participate in a short-term rental, right, an investor must pass one of the following tests. He or she spent greater than, more than 500 hours during the year. Okay. He or she spent more than 100 hours during the year on their short-term rental and more than anybody else, including cleaners and property managers. Or he or she spent substantially all the work on the short-term rental. Okay. As an examiner, I will tell you, go for the greater than 500 hours, guys. Who's my Airbnb, HomeAway, VRB folk? Who has any short-term rentals? Who has short-term rentals? Okay. You would document your hours in the same way in Reps Tracker. Now you can use Excel. You can go the archaic route, keep your folders, keep email folders, keep folders on your desktop. You can do that if you want to. It's just much easier if you use the app Reps Tracker. There is no other app like it so far. That is the only one. Okay. So this is the way you get around being a full-time W-2 employee and trying to meet real estate professional standards. You would go the short-term rental route, which is not an activity in Section 469, which is rental activity. Now you're going into just the regular business, right? This would be your Schedule C. Or if you choose to LLC, it would not be considered rental activity. Okay. The other exceptions, my full-time licensed real estate agents, but you do not have to be one. Okay. You do not have to be, but if you are, great. You don't have to do any of the logging of the hours, but I will always encourage it because I'm an examiner. I will always believe in receipts and documentation. Okay. So you have to be an actual full-time practicing licensed real estate agent. Okay. Not just have your license. So now that we know we can offset all income if we meet these specific guidelines, let's talk about how we offset it. Okay. We're going to go into depreciation, right? Depreciation. There's depreciation via tax, right? Which translates to money via book. Now, if you don't know the difference between tax and book is a nice word for actual expenses, actual accounting, right? 2 + 2 is 4. It's not that way in tax. So let's go into depreciation. Depreciation is an expense given but not paid. It accounts for normal wear and tear of your property since it's an asset placed in service. Asset. It's a business activity to the IRS. All right. So for those of you who have 4 units and under, okay, your depreciable basis is 27.5 years. Don't worry. I'll go into what that means. For those of you who have Airbnbs, no matter how many units, or a property with 5 or more units, you have a commercial property or commercial activity, if you're a short-term rental person, your depreciable basis is 39 years. Okay, so I'm going to go over the most common example, which is 27.5 years. Those are people who have 4 units or less. Okay, so I have an investment property, and this is my real example. That is, I purchased for $700,000. Okay, and I know you're wondering, why do you have your land value in there? Because land is not depreciable. So we have to pull land value out of the purchase price. Okay, so the purchase price was $700,000. The land value was $50,000. Where do we find our land value? We can go to our tax assessor's office online, right? Or our county clerk's office, town clerk's office online. Okay, you can go to propertyshark.com. You have to pay for that, but they allow you 1 or 2 searches for free. Okay, or a lot of you get that little paper in the mail that tells you what your land value is. Okay, so in this example, my depreciable basis is $650,000, right? I have to pull the $50,000 out from the $700,000, and my depreciable basis is $650,000. That is my purchase price minus my land value, because land is not depreciable. Now I have to take that number and divide it by the 27.5 years. So that means for every year, for 27.5 years, I will get an expense that I don't pay of $23,636 as an investor. I'll repeat that. I will get an expense that I don't pay of $23,636 a year just to offset income, okay, just for being an investor. Now, let's go into bonus depreciation, okay? What is bonus depreciation? Well, depreciation, again, we said is a fancy word for expense. All it does is separate the depreciation of the actual structure from items that are depreciable over a shorter period of time and allocates a cost to these items. I'll bring it all together, don't worry. So in my investment property, right, I get that $23,000, right, every year. Now, bonus depreciation is only applicable for the first year that you place the asset in service. What does that mean? It's ready and available for rent. And so we get what we call a cost segregation study done. And it allocates a cost towards items that are 5 years, which is my appliances. Remember, this is a business. I rent this now. That fridge is not my fridge. That stove is not my stove. That's an asset. It's being used. I got tenants. There's turnover. Your removable flooring, your curtains, your blinds, your carpeting, okay? Everything that's depreciable under 20 years. So they separate it usually, right? Your cost segregation study is separated for 5-year items and 15-year items. So for my 5-year items, I got a total of $83,928 as an expense. For my 15-year items, which is my fencing, my driveway, my walks, right? Those are land improvements. I got $35,000 allocated, right? So for the year that I purchased this item, which was last year, okay, I got a total of $143,000 of an expense that I didn't actually pay. The Tax Cuts and Jobs Act said, hey, we're going to not only give you your regular depreciation, investor, we're going to give you bonus depreciation, right? So I got an extra $100,000 or so, a little over $100,000, right? So $143,000 in expense I don't pay. So let's talk about bonus depreciation and the Tax Cuts and Jobs Act. From September 27, 2017, the enactment of the Tax Cuts and Jobs Act, to December 31st, 2022, you'll get what you call 100% of bonus depreciation. What do these percentages mean? I'm going to go back for you guys. That means since I purchased the property in 2022, this number that was allocated to me via my cost segregation study, we don't do that. We hire a firm in a tax strategies mastermind, okay? I will get 100% of this number and 100% of this number. For those of you who purchased property this year, okay, you'll get 80% bonus depreciation. That means if they allocate a cost of $83,000 and $35,000, you would only get 80% of these numbers, okay? These two numbers here. Plus you'll get your regular depreciation, okay? For 2024, you'll get 60%. 2025, you get 40%. 2026, you get 20%. That means in 2026, if you purchase investment property, you get a cost segregation study done, and the firm says we're going to allocate $83,000 to your 5-year items and $35,000 to your 15-year items, and these numbers are different for everybody, guys. You would only get 20% of this number. Okay, it's still better than nothing, but you would get 20%. That's why 2027 is important, because 2027 you get nothing. Just your regular depreciation. Okay, that's how important it is. So, what is placed in service? A lot of people ask me. A property is considered placed in service when it is ready and available for specific use, regardless of whether or not it's actually used. That means it's ready for rent. You may not have a tenant, but it's ready. So if you purchase a property, say November of 2022, right, 100% bonus depreciation, and it's ready and available for rent before December 31st, you get 100% of your bonus depreciation. If it's not ready and available for rent until, say, February, maybe you have some renovations you're doing, you'll get 80%, because that's when it's ready and available for rent. Are we following? Right? So I purchased and closed on my rental, let's say December 10th of 2022. I did some renovations, right? It's not ready for rent until February 1st, 2023. By the way, guys, investment property can be a single family, multifamily. It can be a condo, whatever have you. It's not ready for rent until February 1st. I'll get my 80%, right? Because that's the schedule. 2023 is 80%. Okay. So let's put this all together. Real estate professional status, offsetting all your income, not just rental, or using the short-term rental route, right, to offset all of your income, plus bonus depreciation, which creates a huge phantom loss, that huge amount that I get that I don't pay, right? So let's put it together in numbers. So remember, my total depreciation was $143,000. So I'm going to go back to that slide really quickly so that you guys can see, right? That's my regular depreciation, okay, plus my 5-year items and my 15-year items. These two items are my bonus depreciation, and it's only taken the first year, okay? So I get 100% since I closed on it in 2022. Okay. Let's say you have rental income of 40K, and let's say you have W-2 or 1099 income, or maybe even business income of 70K, right? Your depreciation wipes all of this out if you're a real estate professional. Now, I'm not even including your mortgage interest, your property taxes, any repairs. I'm just showing you what depreciation does, guys. It knocks out everything. And whatever's left over, I call it the tax account. It's just your suspended losses, right? Your losses that you didn't get to use. So after you take your depreciation and you wipe out your income, you have $33,000 left for the next year. It sits in your tax piggy bank. It's your losses that you get to carry forward, right? Now, as a non-real estate professional, okay, if I have this $143,000 expense, right, I can wipe out my rental income, passive losses, passive expenses, right? But I don't qualify to wipe out my 70K in ordinary income or my 1099 or business income. So my taxable income would be 70K, okay? So I would only be able to wipe out my 40K in rental income. And what was left over would be 103, which would be your losses that you hold on to, right? They don't just go away. They stay in your tax return, guys, waiting to be used up, right? What happens to the leftover losses? They get carried forward. So if you engage in rental activity and say you take your bonus depreciation and you don't meet real estate professional status, or you don't have a short-term rental to avoid the real estate professional status requirements because you're a full-time W-2 employee, okay? You can't spend over 50% of your time in real estate, right? And then the next year you can take that $103,000 and offset, right? Whatever that number is for you. This was just an example. You can take that loss and carry it forward to the next year and offset your income. This is the tool the wealthy use. By the way, guys, depreciation and bonus depreciation are not just for rental property. That's for your business assets too, right? Remember Grant and his jet? That's exactly what he did. He bought the jet, right, before 2022. It was 2019, and he utilized the schedule 100%. He got 100% of the expense. Okay, so expenses given but not actually paid that create fake losses that offset real income. Okay, so bonus depreciation has some caveats. The taxpayer or its predecessor did not use the property at any time before acquiring it, purchasing it, right? Acquiring or purchasing, however you want to put it. The taxpayer didn't acquire the property from a related party. Who's a related party? Grandma, grandpa, mom, dad, kids, grandkids, siblings. Okay, usually linear descendants and your siblings. Aunt and uncle don't count. Cousins don't count. In-laws don't count. Okay. So how much money are you leaving on the table? These are my numbers for 2022. My total mortgage interest for all my properties, right? Because I wanted 100% bonus depreciation. I'm conscious of the schedule, right? That's 100% of expenses that I don't pay. So I have all my mortgage interest, all my property taxes uncapped, my regular depreciation, which is every year, and then my bonus depreciation. That number is huge, guys. My total expenses per the tax code is $606,000. My rental cash flow is $82,000. 606 minus 82 means if I have business income of $524,338, I won't pay tax on it because this is the loss that's created, right? Via my bonus depreciation and depreciation. I hope we're following. It's important. Okay. There's accounting income and there's taxable income. We always want to operate within the tax code. So let's say I have W-2 income, 1099 income of $150,000. And I had rental income of $82,000. And my true rental expenses, accounting, right, are $122,000. My mortgage interest, my property taxes, whatever have you, is $122,000, right? But in the tax world, we have the same expenses, but the tax world includes depreciation. So I have $110,000 sitting in my bank account for my rentals, but the tax code says, well, actually, to us, none of it is taxable because you have a loss. So you physically have the money, but per the tax code, you don't. This is where we want to operate. Real income, taxable income, which is zero, right? I have a negative. Are we following? So we don't need to be a business. It produces cash flow, right? Your tenants pay your rent, right? You recognize appreciation through depreciation, which I call tax flow. You can shelter all your income and it keeps up with inflation. So all my tenants' income, right, rental income pays my housing costs, and all the taxes I save, right, also creates this huge buffer. I have all this savings from taxes I don't have to pay, right? So here's an example of one of my students, Tim Barnett. He was a full-time pilot. Okay, he got back a $43,000 refund because he utilized short-term rentals. Okay, he couldn't go the traditional real estate professional status, right? He had to utilize the short-term rental route, which is over 500 hours. Okay, so that's how big the tax code, how much of an impact the tax code and real estate can have on your wealth. Okay, same thing with Yvonne and Peter Ebanks. They actually utilized real estate professional status. One was not a full-time worker. Okay, and they got back $27,000. Right, they had a property. They had to drive between state lines. The minute they got in their car, they had to document, right, and it was like a 7-hour drive from Virginia to New York. Okay, you document there and back for their property. Okay, so who's scared to be a landlord? Who's afraid to be a landlord? The pandemic scared you, right? But the eviction moratoriums, I know it scared a lot of people. So the rent protection you didn't know existed, my favorite, lease protection insurance. It is a third-party insurance company that covers rent payments should your tenants default, guys. That's right. It's free to the landlord. All you have to do is register your property at www.theguarantors.com. Okay. If somebody could just type that in the comment section for me. You guys can see me, but I can't see you guys. All right. www.theguarantors.com. You register your property. It's free. You invite your tenants to apply for your property. And if they're approved, they have to pay a fee. And it includes lease security deposit replacement. So they don't have to pay you security. They just have to pay they have to pay a fee and pay you first month's rent, which their fee is usually smaller than security. So it's cheaper for them to move in unless they have just terrible credit, okay, and low income, or their situation is not ideal, right? Once they're approved, right, you get a lease bond. This is a lease bond, one of my old lease bonds for my properties in Brooklyn, New York. Okay. You see, I have circled March 1st, 2020 to May 31st, 2021, the sum of $32.50 per month. The total for the lease was $45,500. Okay. Well, let's back up a little bit. Okay. My tenants ended up leaving just about 8 or 9 months into the lease. And I had to file a claim for every month up until May 31st, 2021, and I got every dime. Every month I got $32.50 from the insurance company. Okay, every month. No, the company is not Chase for Business. That's just who they use. It's called The Guarantors, www.theguarantors.com. Okay? So it's a good way to secure a good inventory of tenants, because your asset really is not your properties, it's your tenants. Properties don't just pay the bills. But it's a good way to secure a great inventory of tenants and to protect yourself, because somebody who's under the insurance is not likely to just default. All right. So let's talk about my business owners, my small business, my self-employed. I love all of you. Just so you know, bonus depreciation applies to your equipment, machinery too, right? Your vehicles. Okay. So there's no real difference. I just showed you real estate because I wanted you to see the huge impact. Okay. So you can use it for other items as well. So my business owners, it's section 61, gross income defined, section 162, trade or business expenses. That is your Bible. Section 179, right? Which also it comes hand in hand with bonus depreciation. And section 6001, books and records. If you don't document it, it didn't happen, baby. Okay. So let's talk about the difference between LLCing yourself, right? Becoming a business, and being an employee. Have you guys been watching like Bloomberg with Biden, right? And he set up all these LLCs and he had no operations, right? And they found that these were just shell companies that were receiving income but had no real expenses. They just income coming in. Yeah, you don't want to do that. Okay. If you're going to LLC yourself, you better have operations. Income, expenses, you better be producing a product or a service, guys. Okay. So as an LLC, right, your business, you can take your home office, which is expenses, which is your partial mortgage or rent, whatever square footage relates to your home, your vehicle, which is huge, right? Your internet, cable, utilities. My favorite is your retirement. We talked about tax avoidance first, but tax deferral comes second. As a business owner, if you open up a SEP IRA, you can contribute up to $66,000 this year, as opposed to an employee who can only contribute up to $22,500. Okay, it's up to $66,000 or 25% of your compensation, whichever is smaller. Okay, this is the key to building your wealth after tax avoidance. So you save all that money in taxes using real estate, right? And then you dump the maximum into your retirement every year. Consultation fees, advertising, business travel, continuing education, right? All of this stuff. Okay. Whereas an employee, you might get your medical expenses, but they have to exceed 7.5% of your adjusted gross income, which is very, very hard. We talked about retirement, which is 1/3 of what you usually can contribute as a business owner, and your mortgage, interest, and property taxes, as long as it doesn't exceed the standard deduction, which for most people, it won't, because your standard deduction every year is just going to keep going up. Okay. What do we need? Material participation. Over 500 hours a year. That is 42 hours a month. That is an hour and a half a day in your business, so that you're not deemed a hobby. We don't want that. So I'll give you an example. You have an employee who has $75,000 in employee wages. That employee has a business on the side. And that employee has a car. That employee has equipment or machinery, right? Because they took Section 179 and bonus depreciation, they have what we call a loss via tax. Remember, we talked about book accounting, real numbers versus tax numbers. They have this imaginary loss because of bonus depreciation, Section 179, right? So that means to the tax code, right? If you didn't have your LLC, you didn't have your business, your tax, and these are quick and dirty envelope numbers, guys. This is straight from the IRS website. Your taxable income as an employee, right, is 22% tax rate, 16.5% in taxes, 16,500 in taxes. Whereas to the tax code with your business, right, those fake expenses, yeah, right, you only have 25,000 in income, and your tax liability is 3,000, which is 12%. All because you utilize this fake loss. It's fake expense. It's faux expenses that offset real income. Okay, from 22% to 12%, and that's just quick and dirty numbers. Okay, record keeping. This is probably one of the biggest issues I faced as an examiner in my former days as a preparer. If your business and your personal expenses are too intertwined, the IRS can justify your business as a hobby. What does that mean, guys? Hobby expenses and hobby losses are not allowed. They'll remove all your expenses and tax your income. And we don't want that. And an examiner is just waiting for that, right? It's easier than examining. If you have 82 credit card statements and so many bank accounts, it's too messy, right? It's not adequate record keeping. All right. So in the Tax Strategies Mastermind, I teach my students the most simple way: one credit card for your business expenses, and try to make it a business credit card as soon as possible. One bank account for your business income, right? If you have multiple businesses, please separate them. We download it right from our credit card website, our credit card company website, run into Excel, and we keep a running ledger every month. This is what we use to track our tax liability in real time, right? So let's talk about audit pitfalls. You have no operations, but you just form your LLC. Please don't listen to people telling you to deduct your car. All you need is an LLC. Okay, that doesn't work. You have no formation, but only operations, right? A lot of times people are overzealous when they start business. They just swipe in their personal credit cards and they start, loosely documenting their operations, but they don't have a solid business structure, right? You don't want to operate under Schedule C for so long, guys. Okay, at some point, you do want to open up that LLC. Okay, not establishing or defining your business activities, right? What is your business? You know how many tax returns I've looked at and I don't know what these people are doing? I see some income, I see some expenses, but I don't know what the business is. Okay. Not paying yourself a reasonable salary or a salary at all. So a lot of owners will designate what we call an S Corp status, right? So what does S Corp status do? It eliminates self-employment tax as an LLC/sole proprietor. Okay. Every other business structure pays self-employment tax except for an S Corp. Now, as an S Corp, you have to pay yourself a reasonable salary, right? A red flag is not paying yourself a salary or not paying yourself a reasonable salary. What's reasonable? Okay. Reasonable is you're in line with other salaries of similar position and similar companies. How do you check that? You can go to salary.com. You can go to, my favorite is BizStats, BIZSTATS.com. Choose S Corp, plug in your sales, hit that button. It'll show you what the average salaries are in percentage and in actual numbers. So you know if you're paying yourself a reasonable salary. Okay. The last thing you want is for the IRS to revoke your S Corp status and you have to pay back all that self-employment tax. That's not fun. So if you guys want to learn more, please join me in the Money Masters Academy. Okay, you can visit by going to www.themoneynista.com. Okay, I teach you how to eliminate tax in the Money Masters Academy, solidifying your business activities through structure and operations. Not only through that, but through strategies, how to implement and track your tax liability. Remember this spreadsheet we call it a general ledger. And I do it this way instead of QuickBooks because I want people accountable for what a ledger looks like and what their numbers are. Okay, and we plug it right into over-the-counter software because we plan first and then we prepare. It's not that hard, I promise. So you always know your tax liability in real time, right? This is my 2021 liability. It was zero, right? I got back all my tax liability, all my taxes paid, right? I used my 401k to purchase some property. They withheld 20%. I got that 20% back by what? Real estate professional status and bonus depreciation, guys. Okay? I believe in receipts. And my current tax return. That is all of the taxes I paid through a salary, and I stopped I stopped withholding because I had all that bonus depreciation from the properties I purchased, right? That's the way to not have the IRS take so much money and be waiting for, $50,000, $60,000 in a tax refund, okay? Last tax tale. My CPA is a tax professional. That is a lie. Your CPA is likely a tax preparer. You know how many CPAs people I come across and say their CPA has no clue about bonus depreciation? Because a CPA is not necessarily a tax strategist, right? They're a certified public accountant. They can be a bookkeeper, a comptroller, a tax preparer. They can be an auditor. They can be an AP or AR manager. They can be a tax strategist, but they're not automatically a tax strategist, guys. So you have your typical advisory fees. People always ask me, well, how much for a consult? How much for a tax plan? And these are it. And these are on the low side. Okay. Your annual fee can be anywhere from $2,000 to $7,500. I've seen some go as $15,000, right? Your hourly fees, I've seen it go up to about $500, $600, right? And per plan, which is per year, I've seen it go to about $5,000. So if you're interested, go ahead and visit https, right? moneynistalive.com/buy. It is $26.99 for the course, right? For membership, lifetime, okay? Private Facebook group and access to yours truly. Okay, I do answer my students' personal questions via email and a Facebook group. We have Facebook Lives for the private group, and you get access to the course, including updates. We have the Internal Revenue Code breakdown, audit prevention techniques. That is my specialty. I don't like audits. Income shifting, how to take your W-2 money and shift it into tax favorable transactions like tax avoidance, right? Business structure breakdown from S Corps including how to LLC, right? Sole proprietor, when to sole proprietor to LLC, right? Tax deferral, retirement planning, including cheat sheets. So you can join now at moneynistalive.com or visit www.themoneynista.com and click on the link Join Now. And if you have any questions, let's get to it.
Okay, well, thank you so much, Natasha, for that.
Sure.
That was just a wealth of knowledge. I was seeing the comments coming in the chat, and many people having the same kind of reaction that I was having the first time I sat through your workshop.
It's a lot of information, and I try, but you can only grasp it in the course. It's very, 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 it's not hard. It's just, it takes a while for people to grasp. That's all.
Yeah, my second time sitting through, and I was picking up more than from before. So, like you said, it is just so much knowledge, so much expertise that you have, and just really eye-opening.
Right.
To us, and I'm so glad that we had so many people to express interest in tonight's presentation. That also feel that this was an excellent presentation as well. I'm sure they're probably like, my head was the first night, like my brain was blowing up.
I know. I try to break it down as much as possible, and just, it's a little bit more in depth in the course. But yeah, I definitely try to give a good amount of information. It's like I said, it's more in depth. And I don't have access to the comments, but I would.
Yeah, excellent. You're getting things like excellent presentation. Thanks.
Oh, okay.
Wealth of the information.
I wanted to plug in the website in the comments, but I don't have access. So
yeah. So I think people are very. I saw during live comments coming in, just like several people just typing in like "wow" and game changer, and so sort of things. Very informative, amazing presentation, eye opener.
I'm so glad you guys loved it.
Taking a lot of notes, probably like I did too. I was like writing down everything that you were saying. So
important, and it's. I want to just reiterate to people, we don't have forever. 2027 will be here before you know it.
Oh, absolutely. I was looking at that scale, and I need to get busy. So I have my takeaways, and I need to take some actions here. So just if you could answer a couple of questions for us here. Okay, so here's a question. If we are married, can one of us claim real estate agent professional status and offset the spouse's income?
Correct. Yes. So if somebody's not working, because this is the only way it'll work, if somebody's not working, and let's say your wife isn't working, or whomever, I'm just using wife as an example. I don't care who doesn't work, guys. Right. If your wife isn't working and your husband works full time, no matter what he makes, and by the way, guys, the person who created Reps Tracker, she's a doctor. Her husband's a doctor, but she decided in the pandemic to stay home and focus on real estate and create the app and manage the rentals so that she can offset her husband's W-2, and she has kids. So she said, well, it didn't make sense for me to go to work.
Right.
And we save more money by me being a real estate professional. So she dedicated her time to being a real estate professional. And when they filed jointly, she offsets all his taxable income.
Excellent. I didn't remember seeing that in that first workshop I sat in. So that was great. Yep. We got a comment came in and says, thank you so much. Great information. Learned a lot. My brain's on fire. Yeah, mine
I see it all on the side here. Thank you, guys.
Mine's on fire too. So another question. How many properties do I need to be a real estate professional?
So, and this question comes in a lot. It's not about the number of properties. It's the number of hours. So I had one property. Guys, truth be told, in the Bronx, Department of Buildings got a hold of me for, I guess, illegal bathroom or whatever have you. Somehow I made it through the lender closing and all inspection, and there was some illegalities going on. And I spent over 500 hours alone on that property between inspection, architects, contractors, subcontractors, architects coming back out, inspector coming back out. Driving to and from, and I didn't live close. I lived 2 hours away. So paperwork, signing paperwork. So it depends on the property. Sometimes a property can take renovations, right? You can have renovations on a 3-family that take up 500 hours, right? And particularly if you're like me, you're working with a budget. You can't just say just do it. You have to go pick out the flooring, right? You want to pick out the appropriate flooring for a rental. You want to pick out the appropriate contractor, right? Cost and quality. You've got to interview the contractors. You've got to inspect the work, right? You may have 3 or 4 different contractors that come in. You got to let them in, and you might sit there during the renovations like me because I didn't live close. So once I was there, I sat there, right? So it could be 1 property or it could be 10 property. And then there's properties that you don't even have to touch. Like nobody bothers you, right? I have properties that I'm like, the rent just comes in and that's it. There's nobody no repairs, no problems, knock on wood, thank you. But it depends on the property. And you would know that going in because a lot of people, like say married couples, they go and they find a fixer-upper and they figure, or they find out once you knock down those walls.
Oh, yeah.
Right. And there's your 900 hours.
Maybe 900.
Right. And sometimes the husband or my agent that sold me the house, her husband did all the work. Sometimes your husband and his dad can do the work, and family comes up, there's your hours.
Okay, so it's all about the hours.
It's all about the hours. Everybody's situation
more about the hours.
Yeah, everybody's situation is different. Like some people can lay floors. Your husband can lay floors. That's his hours.
Yeah, you might learn how to lay a floor.
You might YouTube how to lay a floor.
Absolutely. So another question, can I convert my primary residence into an investment property?
Sure can. Sure can. I think that's most people's hurdle. They don't want to let go of their home. I learned fast. Goodbye. I gave it up like a bad habit. I think that is kind of like the emotional barrier for most people.
Right.
To build wealth is to let go of their thoughts on their primary residence because it's a sense of a sense of accomplishment.
Right.
But it doesn't translate financially.
Yeah. So, and one of the earlier comments that came in, somebody said something about, isn't it the American dream to own your home? So, but after listening to this, I think the American dream has shifted.
Only Warren Buffett still owns his childhood home. He didn't go anywhere, and I don't blame him because it doesn't make sense.
Yeah,
it just doesn't make sense. Yeah. It's only in our heads we view it as like such an accomplishment, and then it's like once the sticker shock wears off.
Well, everything has changed with the tax code that makes it, seeing it through this lens of enlightenment.
Yeah.
Right? Is a different perspective.
And just so you guys know, this year I just bought my primary residence. This year. I just got here in March, and it's only when my properties cash flow to pay my mortgage.
That's
how important it is not to jump into your primary residence first.
Thank you for that tip. So one more, another question. I live in my home, but rent rooms. Can I claim bonus appreciation? No.
Bonus depreciation? No. You cannot be a primary resident. It doesn't work. It does work with multifamilies. That means you have separate units. You can take bonus depreciation for the units that you do not occupy. And
so if that unit is available and ready to rent, then you can take the bonus appreciation for it?
You can take the bonus depreciation on the units that you have available and ready to rent that you do not occupy. So if you have a fourplex and you have bonus depreciation of, just say, 100,000, you can only take 3/4 of that 100,000, so 75,000, because you live in one of the 4 units.
Okay, got it. All right. So what happens if I don't make real estate professional status?
Keep trying and take your bonus depreciation, because when you do meet it, that, like I said, those losses, right, from bonus depreciation, they sit there. They don't just disappear. They're waiting for that. They're waiting for some income to offset. So that's your the tax bank account. I call it the tax piggy bank.
Because it can carry over from year to year.
It's way more important than your bank account.
Oh, okay. It seems like it.
Mhm.
Uh, so, what is appropriate documentation?
Invoices, email correspondence, screenshots of texts, DocuSigns, right? I've uploaded my sale agreements. I've uploaded appraisals. I've uploaded inspections. I've uploaded everything and anything. I've uploaded invoices from contractors. I've uploaded all kinds of stuff to show that, this is the thing, guys. Would you believe your story with the information that you provide?
Mm-hmm.
Right?
Mm-hmm.
It's not just random. You can look up ABC Gutter Cleaning Company and you see the invoice and you have the corresponding charge on your credit card that does not have your personal expenses.
Mm-hmm. So what about the, like if you're logging a lot of hours for the lawn maintenance or snow removal that you're doing yourself, for the repairs you're doing yourself, what's appropriate documentation?
Just type it out into, like, I use Reps Tracker. That's something that you can, and an examiner is not stupid. They're going to say, okay, well, you do need to mow your lawn. I mean, they have a home. I mean, they know that. You're not going to tax court for that.
Okay, so I put my business expenses on my personal credit card. Is that okay?
In the beginning, it is. Try to transition to a business credit card. So when you get your LLC together, which I show you how to do that in the Tax Strategies Mastermind, which is you can go online, right? Once you get your articles of organization, which you get for most states, you can get the paperwork right there online, except for Florida. And you go down to the bank with your ID, some mail, and the articles of organization, and you open up a business bank account. Right then and there, ask them for a business credit card. Chances are it won't be a huge line of credit, but it might be something if you have decent credit on your own.
Okay.
Try to transition at some point.
So I'm a freelancer. Do I need to have a license?
A real estate license?
Mm-hmm.
No. Freelancers, and I address freelancers separate from business owners because people will say, what's the difference?
Mm-hmm.
Freelance is kind of like freelance. They just here and there, right? Try to be more intentional about your stuff, right? LLC your business. If it's graphics and design, LLC the business. Have that business bank account. Don't think because you're just freelancing on the side, no.
Mm-hmm.
No.
Make it official.
Make it official so that you can get your mortgage interest, right? Some home office deduction, some vehicle deductions, right? Make it official. Don't just ad hoc it, please. You're missing out on a lot.
Okay. So another question, where do you suggest people get the money to get started with buying their first investment property?
This is a big secret, guys. Ready? Mm-hmm. Your job.
Okay.
Save money. And also you can do a home equity line of credit, cash out refinance. I use my 401k a lot. I know people are afraid of touching it, and that's been the mantra since the boomers. Like, don't you touch that 401k. To me, that's bull now. That shouldn't be your goal. That shouldn't be your only fallback for retirement. And if you can utilize it now to make money for you, mm-hmm. I would do the numbers depending on the property. But yeah, you utilize
to what you said for tax deferral versus tax avoidance.
Mm-hmm. Yeah. Mm-hmm. Tax avoidance. Take your tax deferral money and use it for tax avoidance.
Right. Makes a lot of sense.
Mm-hmm.
So that brings us to our last question that we have for this evening. So do you have, I want to just spin it to you to see if you have any final comments or.
Absolutely. The tax code is more important than you know. I struggle seeing people come out during filing season as if it's the time when you should be thinking about it, when it's too late. When January hits and you're looking for your W-2, it's too late. You should be already on that year, right? You should be already executing your tax plan for the current year. This is where most of us go wrong. Please do not just refund shop and think it's a holiday. No, your tax liability is all year long, guys. You're here. It's May. I'm giving you the information. You still got time. It's There's no forever with bonus depreciation. Utilize it. Like, go for it.
So in 2027, that's when bonus depreciation ends.
There is none. December 31st, 2026 is your last go. If you don't close by then,
that's it.
You get
There's
nothing.
Wow. Okay.
And that goes for your equipment too, right? Because I show bonus depreciation with real estate because it's huge, but that goes for your car. It goes for machine. My mom has an $11,000 embroidery machine. So if she were in business, and I didn't buy it because I don't believe in buying stuff that don't cash flow, she would be able to take bonus depreciation on that machine, right? So if somebody likes crafts and stuff and they get these huge machines, that's an example. You can have bonus depreciation on that as well, guys. So I just show with real estate as an example because it has huge impact, but it goes for everything.
Is that why so many businesses are buying a real estate property right now?
Yeah, 2027 is it. This is the window, and you gotta snatch it.
Right. Well, thank you so much,
thank you everybody for
taking the time to present this valuable information to us for our May Week program. I'm sure everyone has been enlightened. You've got everybody's head spinning, smoke blowing out our ears. You got us stressing. Think about all of what we need to do and on this crunch timeline.
Well, you've got the website, right? You got the link. You've got my resources. So I hope to see you guys there.
Absolutely. Well, you'll definitely be seeing me.
Thank you, guys.
Thank you. And thank you to all our participants who joined in for this evening's events. Thank you so much. So go out and be the force multiplier. Thank you so much.